The Middle East conflict is officially widening. Oil just spiked to $85 a barrel, Qatar is shutting down aluminum production, and gold just crashed 4%. The media is panicking, but Wall Street is telling its wealthiest clients to buy the dip. Welcome to the Tuesday close.
And welcome to the deep dive. We are stepping right into the absolute chaos of the market today, and we're so glad you're here with us.
Yeah, if you're watching your terminal right now, you know exactly how disjointed this session feels. Our mission today is to cut entirely through the headline noise. We've got to break down the systematic mechanics of what's actually happening on the ground, and more importantly, in the order books.
Right. It's a critical day to be doing this precisely because the tape is telling a very different story than the front pages. I mean, we are looking at a massive structural divergence between the escalating geopolitical reality and the calculated, almost robotic capital allocation moves being made by institutional money.
Exactly. So let's set the stage. Today is Tuesday afternoon, March 3, 2026. The news cycle is completely dominated by a severe military escalation.
And we've got a formidable stack of sources in front of us today to unpack it all.
We really do. We're pulling live market data from Yahoo Finance, breaking news reports from Bloomberg, and we're looking directly at internal client notes from major Wall Street firms. We've got Mizuho, Morgan Stanley, Piper Sandler, Bank of America, and Wells Fargo.
It's a heavy stack.
It is. But before we get into the microstructure of these trades, I need to establish our baseline for you. Our sources today cover a major escalating military conflict involving the United States, Israel, and Iran. We are looking at a live, kinetic war.
Yeah, which is heavy.
Extremely heavy. But this analysis we're doing right now is entirely impartial. We're not here to take a political stance, not domestic, not international.
No, not at all. Our singular objective is to impartially report on the content provided in these sources.
Right, and analyze the resulting economic and market implications for you. We're not endorsing any geopolitical viewpoints here. We are strictly translating the facts on the ground into the financial reality we are all forced to navigate today.
And that separation is vital, for anyone trying to manage risk in this tape. You have to divorce the human element and the political theater from the raw data.
Because the data is painting an incredibly complex picture.
It really is. When you have literal airstrikes happening concurrently with a major equity index that is actively pairing its morning losses,
Oh, it's wild.
you have a broken correlation. You have to look under the hood at the liquidity plumbing to understand why.
Okay, let's unpack this. We have to start with the geopolitical fact pattern that's driving all this volatility.
What, essentially?
Right, the what. According to our Bloomberg and Yahoo Finance sources, the timeline dramatically accelerated over the weekend. On Saturday, the U.S. and Israel initiated a major airstrike campaign against Iran.
And this wasn't a localized tactical strike.
No, this resulted in the death of Iran's supreme leader, Ayatollah Ali Khamenei.
That is a total decapitation of the command structure.
Exactly. Furthermore, Israel has followed up today, Tuesday, with a fresh wave of strikes hitting Tehran directly.
What's fascinating here is the immediate asymmetric response we're seeing.
Yeah, lay that out.
Well, we aren't seeing a localized containment. Iran is retaliating, and they're leveraging their geographic proximity to global energy infrastructure to do it. The sources note that Qatar reported Iranian targets hitting sites across its territory.
And Qatar is arguably the most critical node in the global LNG matrix.
Without a doubt. That proximity to the kinetic action prompted Qatar to halt its LNG production entirely.
Just a complete shutdown.
Right. And on top of that, a fire broke out at a key storage hub in the United Arab Emirates.
And we know Fujairah in the UAE is a massive bunkering and storage hub.
It's massive.
If you take out storage capacity there, you are immediately disrupting the flow of crude before it even gets loaded onto a VLCC.
Yeah, the supertankers.
Which brings us to the ultimate strategic choke point, the Strait of Hormuz.
The big one.
Iran's Revolutionary Guard Corps has officially declared it closed. They've explicitly threatened to fire on any transiting vessels. In fact, 5 vessels have already been struck.
It's not an empty threat.
Not at all. Al Jazeera published video footage on Monday afternoon showing an oil tanker ablaze right in the middle of the strait. We have moved from a risk premium to literal physical supply destruction.
If we connect this to the bigger picture, you have to understand that the Strait of Hormuz is the single most vulnerable maritime choke point in the global economy.
Give us the scale of it.
You're looking at roughly a fifth of the world's daily oil consumption passing through a waterway that is only 21 miles wide at its narrowest point.
21 miles, that's nothing.
It's nothing. And the actual shipping lanes, they're only 2 miles wide in either direction. So when the IRGC declares it closed and provides visual confirmation of a burning hull, the maritime insurance markets just freeze.
They completely seize up.
Exactly. You are no longer modeling for tail risk. You are dealing with a hard start in physical commodity flows.
The institutional muscle memory here is incredibly stubborn, isn't it?
Oh, absolutely.
You look at the client notes from Morgan Stanley and Piper Sandler, and the prevailing assumption is that markets should just look through this. We've seen flare-ups in the Gulf before, right?
Sure, tanker seizures, drone strikes on Saudi facilities like Abqaiq back in 2019.
Right, and the market usually prices in a brief premium and then violently mean reverts.
That is the established algorithmic response. Markets have been trained over the last 2 decades to fade geopolitical spikes in crude.
They just short the pop.
Exactly. The initial pop is usually aggressively shorted by systematic funds under the assumption that diplomatic channels or, military deterrence will restore the flow of oil within days.
But I want to highlight the client note from Nitin Kumar, an equity analyst at Mizuho.
Yeah.
He stated explicitly, quote, "This time may be different."
Which is the classic contrarian red flag.
Right. Anytime someone in finance says this time is different, you immediately check your sex.
Absolutely. But Kumar's thesis is grounded in the actual mechanics of the disruption.
How so?
Well, he's pointing out that previous conflicts generated a muted long-term response because the underlying plumbing of the physical supply chain remained intact.
Right. The ships still move.
Yeah, ships could still get underwritten by Lloyd's of London, albeit at a higher war risk premium. But this time, we are seeing concrete systemic disruptions in shipping and insurance markets that are halting flows entirely.
Ben Cahill, a non-resident fellow at the Arab Gulf States Institute, told Yahoo Finance that this is having a big psychological impact.
And that's the key phrase. Psychological impact. We are transitioning from a probabilistic risk model to a definitive physical blockade, where marine insurers simply will not underwrite the voyage.
And if you can't get a hull and machinery policy, the vessel does not sail.
It sits at port, the oil stays stranded.
And when the marginal barrel of oil is stranded, the spot price of the available crude goes absolutely parabolic. Let's look at the commodity squeeze on the tape today because the data is violent.
It's staggering.
Brent crude spiked above $85 a barrel. That is a roughly 15% surge since Saturday. WTI jumped more than 9% this morning before finally pairing some of those gains.
But it isn't just the crude benchmarks.
No, not at all. Heating oil is up nearly 9%. Natural gas is up 6%. European gas prices are surging. RBOB gasoline futures caught a massive bid. And then there's the aluminum shocker.
Right. Qatar's state-owned aluminum producer declared force majeure.
The supply chain is completely fracturing.
This is where you have to isolate the derivative effects of that energy shock. A 15% surge in the baseline cost of global kinetic energy in basically 3 trading days is a massive exogenous tax on the global economy. This flows directly into the operating margins of every logistics, manufacturing, and transportation company on the planet.
It hits everything.
Everything. It reprices the cost of bunker fuel for container ships, the jet fuel for air freight, the diesel powering the domestic trucking fleet.
And the sovereign panic is already visible on the tape. You look at the immediate pivot from major net importers. China, the world's largest oil importer, immediately issued a public call for all sides to ensure the safe passage of ships through the strait.
Which shows you how exposed they are.
Highly leveraged to Middle Eastern crude. Their strategic petroleum reserves can only buffer a sustained blockade for so long. But the more aggressive move came from Indonesia.
Yeah, that was telling.
They have already pivoted, announcing they will source part of their crude from the United States as a direct alternative to Middle East shipments.
The Indonesian pivot is a massive leading indicator of structural panic.
Break that down for us. Why is that such a big deal?
Because rerouting a national energy supply chain from the Persian Gulf to the U.S. Gulf Coast is a logistical nightmare.
Right.
You are changing the voyage duration, the freight costs, and potentially the specific grade of crude your domestic refineries are calibrated to process.
Oh, because they're swapping grades.
Exactly. They are swapping Middle Eastern medium sour for U.S. light sweet. That requires distinct refining adjustments. The fact that Indonesia is willing to incur those operational frictions immediately, it reflects a complete lack of faith that Hormuz will reopen quickly.
But there is a massive political counter-narrative trying to cap this panic, isn't there? We have to look at the messaging coming from Washington today.
Yeah, the press conference.
Right. President Trump held a press conference today with the German Chancellor, Friedrich Merz. Trump addressed the energy spike directly, stating he expects the higher oil prices to be, quote, short-lived.
Short-lived.
Yeah. He acknowledged we might see a little high oil prices for a little while, but insisted that as soon as the conflict with Iran is over, prices will come down.
It is a calculated dual-track communication strategy. On one hand, he is projecting maximum deterrence, vowing whatever it takes on Iran to secure the geopolitical objective.
Right.
On the other hand, the administration, with Defense Secretary Pete Hegseth, actively rejecting the idea of an endless war, they are trying to jawbone the energy markets.
They're trying to thread the needle.
Exactly. Projecting absolute military dominance while simultaneously promising the algorithmic traders that this is a contained transient event.
But the forward curve on Brent isn't entirely buying the short-lived narrative. The backwardation is steepening aggressively. And this is exactly why this matters for the broader macro picture.
Yeah.
This is a synthetic geopolitical supply shock hitting right when the market thought the structural inflation narrative was finally dead and buried.
Which is the worst possible timing.
Right. Usually crude drops when the global PMI data is weak or rises when we are in a synchronized global expansion. This is completely divorced from the business cycle.
And that synthetic shock to the inflation baseline is triggering absolute chaos across asset correlations, which leads us to the most structurally bizarre market action of the day.
Here's where it gets really interesting. In a macroeconomic environment defined by a live kinetic war in the Middle East, a decapitated Iranian command structure, burning tankers in the world's most critical maritime choke point, and a 15% spike in crude rig.
And surging aluminum.
Right. Gold is getting absolutely taken to the woodshed. It just tumbled 4%, completely erasing all of its weekend gains.
It completely violates the traditional safe haven heuristic.
It violates centuries of market theory. Gold is supposed to be the ultimate non-sovereign store of value during a geopolitical crisis.
Right.
But today, GCF dropped like a rock. It's the biggest single-day slide since January 30th. And the bleed is systemic across the precious metals complex. Platinum is down 10%, silver is off 6%, palladium is down 7%.
It's a bloodbath.
So if you are long physical metals expecting a geopolitical bid, you are getting destroyed today. Why?
Because you are caught in the blast radius of the dollar pain trade. What we are witnessing is a pure mechanical liquidity event.
A liquidity squeeze.
Exactly. To understand the metals sell-off, you have to look directly at the U.S. dollar index, the DXY. It is surging vertically.
It really is.
It's nearing 3-month highs, hovering right around the 100 level. This is the largest two-day surge for the dollar since late July.
I want to pull in a quote from Robin Brooks at the Brookings Institution because he nailed the severity of this move. He posted that the dollar is, quote, going vertical, and added, this kind of spike has the potential to be highly disruptive.
Highly disruptive is an understatement when you look at the plumbing of the offshore dollar system.
Walk us through that mechanics. When the broader equity market sells off and the U.S. dollar spikes, what is actually happening on the institutional desks?
Well, when a massive, unmodeled geopolitical shock hits, the initial reaction across global equities and emerging markets is a sharp de-risking because the global financial system is entirely dollar-denominated.
Specifically the euro-dollar market.
Right, the massive euro-dollar market and foreign corporate debt. So capital aggressively repatriates into the U.S. dollar for absolute safety and to service those dollar-denominated liabilities.
A rush for cash.
Exactly. But it creates a cascading margin squeeze. When the dollar spikes aggressively against a basket of fiat currencies and your broader risk assets are dropping in value, prime brokerages and clearinghouses instantly hike their margin requirements.
To account for the increased volatility.
Right. If you are an institutional fund running a levered book, your risk desk is suddenly hit with massive variation margin calls. They need USD, and they need it instantly.
And you don't sell what you want to sell, you sell what you can sell.
Precisely. You cannot liquidate your private credit book. You cannot easily exit a massive position in a small-cap biotech stock that is offering zero liquidity on the bid.
No one's buying that today.
Exactly. You are forced to sell your most highly liquid, actively traded assets. Gold is one of the most liquid markets on Earth, so Institutional traders, systematic macro funds, and CTAs are forced to aggressively liquidate gold futures simply to meet margin calls and raise cash.
It is a mechanical forced liquidation.
Yes. It has absolutely zero to do with a fundamental reassessment of gold's intrinsic value as a safe haven. Gold is simply acting as a global ATM for funds desperate for dollar liquidity.
I think framing it as a forced liquidation completely changes the lens through which you view this tape.
Right.
It separates the emotional retail reaction, wondering why the classic inflation hedge is broken, from the systematic reality of clearinghouse mechanics.
Right.
You really have to look at the cross-currency basis swaps to see how desperate the scramble for dollars really is today. But while institutions are scrambling for dollars, we also saw a massive capital flight happening on the blockchain over the weekend.
Oh, the crypto movement in Iran. That was staggering.
Millions of dollars in crypto vanished from Iranian platforms in the hours following the weekend strikes. Citizens literally rushed to secure their wealth on the blockchain as the real-world infrastructure was getting hit.
It's a fascinating contrast. The institutions dump gold for fiat dollars, while retail citizens in the conflict zone dump their fiat for decentralized crypto.
Two completely different liquidity panic responses happening at the exact same time.
Exactly. But what's really fascinating here is that the dollar dynamic exposes the hidden fragility of the global fiat architecture. That 100 level on the DXY isn't just a psychological round number.
It's a structural threshold.
It is. It represents a critical threshold for emerging markets. If the dollar index breaks and holds above 100, the debt servicing cost for any sovereign or corporate entity in the developing world that borrowed in dollars become exponentially more expensive.
Right, as their domestic growth is stalling due to the energy shock.
Exactly. It's a doom loop.
So we have a bifurcated crisis. Oil and aluminum are surging on localized physical supply destruction, while gold and precious metals are tumbling on a global dollar liquidity squeeze. Let's pivot to how this is manifesting in the broader equity markets, because the tech sector exposed a severe vulnerability today.
The broader indices had an incredibly volatile session. They gapped down hard at the open. The S&P 500 had an early drop of 1.2%.
Which is a significant move given the low volatility regime we've been in.
It is. But then, true to recent form, they systematically paired their losses. By 2 p.m. Eastern Time, the Nasdaq was down 0.8%, the S&P 500 was down 0.8%, and the Dow was down roughly 0.7%, which is about 350 points.
Considering we have burning tankers in the Strait of Hormuz, a 0.8% drop on the S&P 500 feels almost unnervingly calm.
It does.
But if you look under the surface, the real damage was concentrated in the engine of the current bull market, the semiconductor space. The iShares Semiconductor ETF, the SOXX, opened just under its 50-day moving average.
That is a critical structural development. The SOXX hadn't breached its 50-day moving average since December. Breaking that trend line signals a fundamental shift in institutional momentum. The broader Philly Semiconductor Index, the SOX, was indicated to open 8% down from its record high.
You look at the semiconductor drop, and on the surface, it feels disconnected. They aren't mining raw silicon in the Persian Gulf. Why is the most advanced technology sector on Earth acting as the beta for a Middle Eastern ground war?
Because semiconductors are the most hyper-globalized, energy-intensive manufactured product in existence.
Right.
The supply chain for a single advanced microchip crisscrosses the globe dozens of times before it is finally assembled into a server rack. You have raw materials from Africa, specialized chemicals from Japan, lithography machines from the Netherlands, fabrication in Taiwan or South Korea, and packaging in Malaysia.
It's a massive logistical web.
Exactly. And when global energy prices spike 15%, the freight and logistical costs of that incredibly complex ballet skyrocket. Furthermore, advanced fab plants require a staggering amount of baseline power to operate EUV lithography machines.
So an energy shock is a direct hit to their operating margins.
A direct hit.
And there is a massive international contagion effect here. You look at the iShares MSCI South Korea ETF, EWY, and it absolutely cratered today. It sank 12%, which is its worst single-day drop since 2020.
What's fascinating here is, if we connect this to the bigger picture, South Korea is effectively a leveraged proxy for the global growth and energy matrix.
How so?
Well, South Korea imports almost all of its energy, meaning a 15% oil spike is devastating to their terms of trade. Simultaneously, their equity market is heavily weighted towards semiconductor giants like Samsung and SK Hynix.
So they get hit on both ends.
Exactly. So, as the global chip sector gets aggressively repriced downward due to macro fears and rising input costs, South Korea catches the absolute brunt of the sell-off. The one depreciates against the surging dollar, their energy import bill explodes, and their primary export sector gets hammered all at once.
It is the perfect macroeconomic storm for EWY.
Truly.
But, to add some texture to the tape, it wasn't a synchronized sell-off across every sector today. We actually saw a brief retail pivot. Target, ticker TGT, saw its shares catch a bid in the pre-market after posting earnings. They reported same-store sales growth of only 0.5%, which actually missed the street estimate of 0.9%, yet the stock moved higher.
How do you interpret that kind of price action in this macro environment?
I look at Target as the canary in the coal mine for the U.S. consumer. A 0.5% comp miss is a data point from before this weekend's oil shock.
Right, it's backward-looking.
Exactly.
Yeah.
If we see RBOB gasoline futures translate to a 40-cent hike at the pump, Target's discretionary categories, apparel, home goods, electronics, they are going to get completely wiped out. The consumer is already walking a tightrope, and this energy tax leaves them with zero margin for error.
Yeah.
The fact that the stock caught a bid today on a revenue miss might just be aggressive short covering rather than a genuine fundamental endorsement of their forward guidance.
That is a highly probable read on the tape. Target's pre-market bump is idiosyncratic noise compared to the massive structural shifts we are seeing in energy and currencies.
Which brings us to perhaps the most fascinating divergence of the entire session. The absolute unflappability of Wall Street's sell-side strategists.
Oh, bulls.
The buy-the-dip industrial complex. It is genuinely stunning. Despite the decapitation of the Iranian leadership, a physical blockade of the Strait of Hormuz, and a 15% spike in the primary input cost of the global economy, the major Wall Street desks are looking at their institutional clients with a straight face and telling them to allocate capital.
The underlying data from the Bloomberg reports confirms this entirely. We are 2 months into 2026, and the S&P 500 has effectively chopped sideways. Yet, the consensus year-end target from Wall Street strategists remains anchored at a level 10% higher than where we are trading right now.
They haven't flinched.
They have not revised their models downward at all. A Bank of America sentiment indicator published today shows that institutional allocation weightings remain completely unchanged despite the weekend escalation.
Not a single major strategist tracked by Bloomberg has downgraded their equity outlook since the U.S. initiated this military campaign. You read the notes from Morgan Stanley and Piper Sandler, and they are actively defending their constructive equity views.
It's remarkable.
They are explicitly advising clients that any intraday pullback related to the Iran conflict should be treated as a tactical dip-buying opportunity.
You have to analyze the underlying rationale here because it isn't just blind optimism, it's heavily reliant on historical precedent.
What's their thesis?
Their bullishness rests on 2 pillars: expectations of resilient, above-trend U.S. economic growth, and the historical observation that geopolitical volatility is almost always transient. They are looking at the data set from the last 50 years.
The Gulf War, the 2003 Iraq invasion.
The 2014 Crimea annexation. And the algorithmic takeaway is identical. The market dips on the initial shock and then systematically recovers to new highs as the conflict localizes. Therefore, selling the geopolitical fear is historically a negative expected value trade.
They are relying entirely on the muscle memory of the post-GFC era. They are assuming the central banks will ultimately backstop any severe liquidity event and that the military apparatus will secure the sea lanes before corporate earnings take a material hit.
Exactly. It's institutionalized recency bias. But this is where the counter-argument becomes critical.
Right. So what does this all mean? If Piper Sandler is pounding the table to buy, who is taking the other side of that trade, and what is their thesis?
The structural bear case today is being articulated by the Wells Fargo Investment Institute. They're acting as the voice of macroeconomic caution, and they're pointing directly at the transmission mechanism that could shatter the buy-the-dip algorithm.
And it all comes back to the oil, doesn't it?
It all comes back to the duration of the oil spike. If crude stays elevated at $85 or pushes toward $100 for multiple quarters, it ceases to be a transient geopolitical shock. It morphs into a structural economic drag. Wells Fargo is warning that a sustained energy shock could trigger a synchronized global economic and corporate earnings recession.
Because if the baseline cost of manufacturing, freight, and consumer transit goes up 15% and stays there, corporate profit margins are going to experience violent compression.
You'll get crushed.
You can't model a 10% earnings per share growth rate for the S&P 500 if the underlying companies are bleeding margin to pay for diesel and reinsurance. The bulls are playing an incredibly high-stakes game of chicken with the Strait of Hormuz right now.
They really are. They are heavily reliant on the political dimension, specifically President Trump's mandate for a short-lived disruption, translating into immediate operational reality for the shipping lanes.
And if it doesn't?
If that assumption is incorrect, the 10% year-end upside target for the S&P 500 is going to require massive downward revisions, which will trigger a significant repricing of equity multiples.
So how do we trade this? Wall Street bulls at Morgan Stanley and Piper Sandler are telling clients to buy the dip because the S&P 500 is only down fractionally.
But the internal rotation is vicious.
Right. And here's the Theta Fuse strategy for navigating this. We don't just blindly buy the dip, we sell the fear. With oil surging and the broader market dropping, Implied Volatility 4 is expanding rapidly. This is the exact environment to sell cash-secured puts on energy ETFs and high-quality dividend stocks at a massive discount.
Let the panic pay you.
Exactly.
Yeah.
Let the panic pay you, which forces us to look at the macroeconomic bedrock underneath all of this, the fixed income market, because this is where the entire narrative collides.
Right. If we connect this to the bigger picture, an exogenous oil shock is essentially a mainline injection of inflation directly into the global economy. And inflation is the absolute kryptonite of the Federal Reserve's current policy stance.
Look at the bond market reaction today. The U.S. 10-year Treasury yield climbed back up to 4.09%. And the sovereign pain was even more acute in Europe.
It was a brutal session for European bonds.
Comparable European yields, specifically UK gilts, French OATs, and Italian BTPs, they all gapped up more than 10 basis points in a single session.
A 10 basis point upward move in European sovereign debt across the curve in one day is a violent repricing of forward rate expectations. Traders in the swap markets are rapidly capitulating on their bets for Federal Reserve monetary easing.
They're pricing the cuts out.
Before this weekend's escalation, the market was comfortably pricing in a terminal rate that assumed a steady glide path of rate cuts. Now they are staring at an $85 Brent print and a surging DXY, and the realization is setting in. The Fed cannot justify cutting the overnight rate if a synthetic energy shock is threatening to unanchor inflation expectations all over again.
And this breaks another fundamental tenet of portfolio construction. Usually, when a shooting war breaks out involving major global powers, asset managers aggressively bid up U.S. Treasuries for risk-free safety, which drives yields down.
The flight to quality.
But the sources note today that Treasuries are actively losing their safe haven appeal. They are selling off right alongside risk assets.
Because the nature of this specific crisis is deeply inflationary. If you lock up capital in a 10-year Treasury yielding 4%, but the global inflation rate spikes back to 5 or 6% because the physical oil market is broken,
So you're losing money.
you are guaranteeing a loss of purchasing power in real terms. The bond market isn't providing the structural ballast it normally does during a geopolitical flight to quality. If you are managing a traditional 60-40 portfolio today, 60% equities, 40% bonds, you are getting crushed on both sides of the book.
Equities are facing severe margin compression from input costs.
And bonds are selling off due to the resurgent inflation premium. The correlation between stocks and bonds is positive, which is the nightmare scenario for risk parity funds.
The Fed is entirely boxed in here. If they cut rates to support the manufacturing sector and ease the dollar liquidity squeeze, they risk turbocharging the energy inflation. If they hold rates higher for longer to fight the oil shock, they risk breaking the back of the U.S. consumer and triggering the earnings recession Wells Fargo is warning about.
They are facing a textbook stagflationary setup, an exogenous supply shock that raises prices while simultaneously destroying demand.
Okay, we have covered a massive amount of technical ground today. Let's synthesize the moving parts. We started with the kinetic reality on the ground, the U.S. and Israeli decapitation strikes against the Iranian leadership, and the immediate asymmetrical retaliation via the closure of the Strait of Hormuz and strikes on Qatari LNG infrastructure.
We traced how that physical maritime blockade instantly translated into a 15% surge in global crude benchmarks, forcing major geopolitical realignments like Indonesia's costly logistical pivot to U.S. sweet crude.
We unpacked the counterintuitive paradox of gold tumbling in the face of war, revealing the massive underlying dollar liquidity squeeze and the mechanical forced liquidations driven by clearinghouse margin calls. We saw the high-beta semiconductor sector break critical technical support levels, dragging heavily leveraged international proxies like South Korea's EWY down 12%.
And amidst all of this structural chaos, we examine the stark divergence of Wall Street's sell-side desks, who are blindly relying on the post-GFC muscle memory to buy the dip. completely discounting Wells Fargo's warning that sustained energy inflation could fracture the entire forward earnings cycle.
And that all funnels directly into the fixed income markets, where rising sovereign yields globally indicate that traders are terrified. This specific energy shock will force the Federal Reserve to abandon its easing cycle entirely. Navigating this kind of disjointed, high volatility environment requires a deliberate step back from the emotional tenor of the headlines. Today is a perfect example of what separates the reactive retail participants from the systematic analysts.
Absolutely.
By looking underneath the equity indices to understand currency basis swaps, physical maritime logistics, and bond curve repricing, you can actually decipher the underlying plumbing of the market. You can understand exactly why asset classes behave the way they do, even when the surface-level correlations seem fundamentally broken.
Knowledge is only valuable when it is rigorously contextualized and applied. Today's tape is an absolute masterclass in why you cannot rely on historical heuristics alone, which raises an important question, something for you to heavily consider as you manage your exposures heading into tomorrow's open.
Let's hear it.
The entire premise of Wall Street's buy-the-dip consensus rests on a singular assumption, that the machine will always fix itself quickly. It assumes that geopolitical disruptions are inherently temporary and will be resolved before they can permanently impair long-term corporate cash flows. But what happens if the Strait of Hormuz is not reopened next week?
Right.
If the marine insurance market refuses to underwrite tankers, and the physical supply chain of global kinetic energy remains stubbornly, structurally broken for months, at what point does that deeply entrenched algorithmic psychology finally crack? At what point does the muscle memory of the last 20 years completely fail, forcing a sudden, violent, generational repricing of equity risk premiums?
That is the ultimate tail risk question, and one the market is clearly not pricing in today. We are reading the comments tonight. Tell us, yes or no. Is this a dip buying opportunity or the start of a massive recession? Drop your answer below. As always, we talk options and strategies here on Theta Fuse, but this is for educational purposes only. We are not your financial advisors. Trade your own plan and stay safe.